Hey, Jack Burdey, Wealth Associate and Associate Portfolio Manager on the Schaefer Financial team here at CG. Given all the recent market volatility due to Trump and the trade war and the tariffs, I wanted to make a quick video discussing what actually drives stock returns. Let's take a look. To properly answer this question, we need to analyze it from a lens of short-term movements and long-term movements. In the short term, there's a wide variety of variables that can affect stock prices. For example, this could be macroeconomics based, which looks at factors that affect a wide variety of businesses as opposed to just one specific company. These could be things such as expected recession or slowdown. It could be interest rates, economic data, wars, politics, you name it. Essentially, these factors affect a wide variety of companies, I would say most companies within an economy, as opposed to just one specific company. Again, discussing short-term movements, there may be factors that don't affect a wide variety of companies but are stock-specific or company-specific. These could include things like a change in management, a change in guidance from management as to how the company is expected to do over the next year or sometime in the future. It could be news, it could be scandals, it could be company earnings. There's a wide variety of factors that could affect a specific company, but not a wide range of companies that are all affected by the same thing. This is because a stock price at any given time is just a snapshot of what investors believe the business should be valued at today, accounting for any future prospects of the business, and how they feel about the business given the current market environment. The stock price is constantly changing, either increasing from buyers wanting to buy the company's shares or decreasing from selling pressure from investors selling the company's stock. This is important because a stock price doesn't necessarily represent the value of the underlying business. Although markets tend to be relatively efficient, especially in developed markets such as the US and Canada, they don't always get it right. Many times, company prices don't accurately reflect what the business may be worth over longer periods of time. For example, let's say that there's a company and bad news comes out. Let's say there's a headline in the local paper that this company is sourcing its supplies from a company that doesn't have very strict labor laws. That company's share price based on that news may drop 10%. That may not affect the company's fundamentals, expected earnings, sales, anything that actually has to do with the company's profitability and its growth. Nothing may change. But now the entire company is valued 10% less. So the market doesn't always get it right in the long term. The difficulty is knowing what something's worth in the long term, given how many variables can change between now and then. However, in the short term, the market does react quite significantly, whether looking at the market as a whole based on macroeconomic or factors that affect many stocks, or an individual security based on something that happened to that specific company. However, when you start to look longer term, I'm not talking about 6 months, I'm talking about years to decades, all of the noise starts to matter less. And there's kind of one factor that drives a stock's return, and that is simply its earnings, its operating earnings. The more the company grows, the faster it grows, and the more profitable it grows. The stock price tends to be highly correlated with the earnings of the company over longer periods of time. That doesn't mean tomorrow, if there's a specific company like Apple, if bad news comes out, that it won't drop 5% or whatever percentage. However, when you look longer term, and you can compare this by looking at past data, over longer terms, stock prices tend to follow the earnings of the company with a high degree of correlation. Let's take a look at a chart. All right, so this is the chart that we wanted to show you here. So what this chart is saying is on this blue line here, this is the operating earnings per share in aggregate of all the companies in the S&P 500. This red dashed line is the price of the S&P 500 stock index. So what are operating earnings per share for the S&P 500? Well, operating earnings per share is just the earnings. Let's look at an individual company, because when we're looking at a stock market index like the S&P 500, all it's doing is aggregating all of the individual companies, weighting them and then representing that as a whole. So if we look at an individual company in the S&P 500, it's just a small portion of that total index. So for operating earnings, what you're looking at is the earnings of the company after deducting any expenses needed to produce the revenue that they generate, and then deducting out any operating expenses that the company might have. These are expenses that the company needs to be able to run. So for example, paying staff. What you're left with is earnings of a company before interest and taxes. All it is taking that number and dividing it by the number of shares outstanding for a company. So for example, if a company's worth $100 and there's 10 shares outstanding, then it's $10 per share. So it's just the total operating income of that, or operating earnings of a company, divided by the number of shares outstanding. Then that number is just weighted by the proportional weight in the S&P 500. That's what this blue line in aggregate is saying. That this is what the operating earnings of all 500, roughly 500 of those companies have done since about 1985. This red line here shows the price, again, in aggregate of all of those underlying companies, so the S&P 500 total price, what it has done over time. Since 1985, the correlation between what the operating earnings of the S&P 500 companies have done is 0.96. The correlation between operating earnings and the stock price of the index is 0.96, which for those who know statistics is a very, very high correlation. A correlation of 1 means that a change in one variable equals a direct change in another variable. So for example, you could represent that by a direct horizontal line, or diagonal line on a graph. It moves up 1, operating earnings move up 1, then the stock index moves up 1, is a perfect 1 correlation. 0.96 is very highly positive, meaning that if you have your money invested in companies that are profitable, that have strong balance sheets, that are growing their earnings over time, that are increasing their share price by creating more value for shareholders, they will continue to grow their earnings, and with a 0.96 correlation, the stock price will increase over time as well. The point I'm trying to make is that over shorter time periods, your portfolio may fluctuate based on a wide variety of factors, many of which are out of all of our control. In today's environment, that's Trump, the tariffs, and the trade war. However, over longer periods of time, staying invested in growing, profitable companies that are growing their earnings and their earnings per share over time has had a very, very strong correlation with positive stock returns. As always, feel free to reach out to myself or the team, and we'd be happy to answer any questions you might have. Take care.